So I hope trading account, profit and loss account, and then classification of indirect expenses that we have done on Saturday. Operating expenses, non-operating expenses, and the segregation of profit and loss account in the operating part and non-operating part, the formulas. We will be doing a lot of practice of these topics in this week also, but continuous studies and continuous efforts from your side is compulsory. Okay, now today we are going to start balance sheet. See, there are three major parts of this chapter that I told you in the beginning also. One is trading account, one is profit and loss account, and one is balance sheet. So, and you should be knowing which account will be written where. And that exercise we are doing since the beginning of syllabus after midterm exams. We have done a chapter capital expenditure and revenue expenditure, capital receipt and revenue receipt. So these all are based on that concept. Okay, now see balance sheet, meaning of balance sheet. It is a sheet of balances of ledger accounts. Obviously, whatever amounts you are writing here for any account, like salary has been written 79,000. It is the balance of salary account 79,000. That ledger account is telling that in the whole year, ending March 31st, 2019, you have paid a total salary amount to be 79,000. Same way, the rent account is showing a balance 37,500. Means for the year ending March 31st, 2019, the total amount of rent paid during the whole year is 37,500. This is your expense for rent. So each and every account is a ledger balance. And from where it is coming, after balancing the ledger, we prepare trial balance. From trial balance, we are getting these ledger account balances. So obviously, trading and profit and loss account is also prepared with the help of ledger account balances. But some of the ledger account balances will go to trading account. Some of the ledger account balances will go to profit and loss account. There is a certain criteria. What is the criteria? All the direct expenses will go to the trading account, and all the indirect expenses will go to profit and loss account. And all the assets and liabilities means all the personal accounts and real accounts are stated as assets and liabilities. Whatever accounts you are writing in trading and profit and loss account, these all accounts are nominal accounts. These are either your expenses or your incomes. So that's why all nominal accounts come in trading and profit and loss account. And rest of the accounts means personal and real accounts come in balance sheet. It shows financial position of the business. Now, financial position means how much assets you are having, what type of assets you are having, what is the ratio between current assets and non-current assets, how many current assets you are having, how many non-current assets you are having. Then it shows how much liability you are having. So it shows your financial position. Suppose you started a business with a capital of rupees 1 lakh, and after 10 years, suppose you are writing here rupees 10 lakh capital. So means your business has grown 10 times in these 10 years. It is a statement, not an account. Whenever we are preparing an account, we generally use the words to and by in an account. But because it is a statement, so that's why here we will not be using to and we will not be using by here. There is no debit credit side. It is prepared on a particular date. Like you were preparing profit and loss account for a particular year, for the whole of the year. But on a particular date means again on March 31st, 2019, what is your financial position, how much assets and liabilities you are having. So that's why it is always prepared for a particular date, as the trial balance is also prepared for a particular date. Yes, please. Meaning of balance sheet is clear. Now I will take up certain contents of the balance sheet. See, first content is capital. On the liability side, it is shown. And in the second chapter, you have learned that capital is the liability of the business. Capital is the liability of the business. You have also studied business entity concept that also says that business and businessman are two different persons, and the capital whichever is invested by the proprietor is liability for the business. Why it is liability for the business? Because whenever the business will get closed, we assume that business will repay back this capital amount to the proprietor. However, it is not compulsory, but it is the duty of the business to repay this capital amount to the proprietor. So now this capital will be increased by the profit earned. In the sole proprietorship, you have learned that the whole profit belongs to proprietor. So that's why whatever the profit the proprietor will be earning in the business, that will be added in his capital, because this profit belongs to the proprietor. So either he will withdraw this profit or he will remain invested that profit into the business. So if he remain invested that profit into the business, that will be treated as his capital now. That's why it has been added to the capital. Same way, if the proprietor has withdrawn some amount of cash or goods from the business for his personal purpose, for his domestic use, then it will be termed as drawings. So it will reduce his capital. That's why it has been subtracted from here. Income tax. Now, who is getting that income? Proprietor is getting that income. So that's why proprietor is liable to pay income tax. And because it is the liability of the proprietor, it is not an expense for the business. So that's why income tax and life insurance premium are personal expenses of the proprietor. That's why these will also be treated as drawings. These are actually drawings. Even if the proprietor is paying that amount from the business, it will be treated as drawings. So now I hope capital part is clear. So there are certain adjustments in capital. Whenever you are writing capital, leave 4 or 5 lines to make that calculations. Now coming to the non-current liabilities. What are non-current liabilities? The liability. Now see, you have learned these all terms in chapter number 2, accounting terms. Do you remember non-current liabilities? Can you tell me? Can anyone tell me? Okay, I will explain. Non-current liabilities are the liabilities which are paid after at least 1 year. Means these will not be repaid back within 1 year. So the loan which you are taking in your business will be paid obviously after 4, 5, 6, 7 years. And if you are a large concern, maybe you are taking amount for long term for 10 years, 12 years, 15 years, 20 years. So these are your non-current liabilities. The amount is not payable within the 1 year. That's why it is termed as here long-term loans. It is termed here as long-term loans. So I hope now meaning of non-current liability is also clear. Now next is current liabilities. Now current liabilities are the liabilities which are payable within a year, which you have to pay back within a year, which is not for more than 1 year. That liability is termed as current liability. So now bank overdraft. Now I hope you all remember the meaning of bank overdraft. We have discussed it many times throughout the syllabus. Bank overdraft is the amount which extra amount you have withdrawn from your bank account because such power has been given to you by the bank. So whatever extra amount you have withdrawn from your bank account, from your bank current account, that amount is termed as bank overdraft. So because you have to pay back that amount within a short period, so that's why it is your current liability. Bills payable, because this chapter we have not discussed till now, that's why I will explain it in short only. The amount of creditors which you have promised in return, the amount of creditors which you have promised in return, that document is known as bills payable. So it is almost equal to sundry creditors. It is another form of sundry creditors that you can say. When we will be doing this chapter, we will discuss it in detail. Now sundry creditors, those who are supplying you goods on credit, so they will give you credit for at least 15 days, 20 days, 1 month, 2 months, not more than that. If you are having very high goodwill, then maybe about 3 months, not more than that. Then outstanding expenses. So outstanding expenses are the expenses which are due now, but you have not paid. Like suppose you are preparing the balance sheet on March 31st. So maybe the salary for March month is still not paid. It has to be paid within the next 4 or 5 days in the month of April. But that salary has been due. You have expended that salary. You have spent that salary. So that's why it is your expenditure. You have to write it on your liability side because you have to pay it within next 4 or 5 days only. Then unearned income, the income which you received in advance. But because you have not earned that income, that's why it is written unearned income. Or you can say income received in advance. Yes, please. Liability side, any query for any point. Okay, now coming to the non-current assets. Asset side we are discussing now. So there are first heading is non-current assets. So on the term of non-current liabilities, you can define non-current assets also easily. These are your fixed assets. Non-current assets are what? These are your fixed assets. Fixed assets means the assets which you will be using in your business for long time. Like furniture, you will purchase once and you will be using that furniture for at least next 4 or 5 years. Same is the case with loose tools. Loose tools are the small tools like screwdriver and many other things like that. So that you will be using for your repair maintenance. So these are your non-current assets because you will be using these assets in for long run. The next one is motor vehicle. Motor vehicle is your fixed asset, whether you are having bike or car. Plant and machinery, it is also your non-current assets. Land and building. Patents are the special rights. Patents are what? Patents are your special rights which provide you some authority for using some formula or for using some invention. Trademark are also special right. Some sort of logo you have created and that mark is known as your trademark because you are identified by that mark. Like you can see on many vehicles, they put their trademark. Then goodwill. Goodwill is also your non-current assets. Now patents, trademarks, goodwill, these all are your intangible assets. And furniture, motor vehicle, plant and machinery, land and building, these all are your tangible assets. Okay, now coming to the long-term investments. So one category of long-term asset is non-current assets. And sometimes what happen, we generally have some idle money in our business that we will not be requiring for long run. Like next 2 3 years, I don't require that money, but it is with me. So what I will be doing, I will be parking that money in some long-term investment. Like I can purchase shares also, I can purchase mutual funds also, I can purchase some debentures also of any company. So various securities are available in the market for long run and short run. So long-term investment means the investment which you have made for more than 1 year. That will be termed as long-term investment. Then next is current assets. So cash you are having either in hand or at bank or whatever promises you have received from your debtors in written that on such date I will be paying your money back. That promise is termed as bills receivable. So bills receivable and sundry debtors are almost same. Debtors are those persons to whom you are giving goods on credit. And short-term investment, right now I explained that there are some securities which you will be investing, like you can invest money in 3 months FD or 6 months FD. So that because that FD will mature within a year, that's why it will be termed as short-term investments. So if any investment you are doing for more than 1 year, it will be long-term investment or it will be non-current asset. Or if an asset is for not more than 1 year, means either you will be using that, either you will be using that asset for next 2-3 months, you will be converting that asset into cash, or you will be consuming that asset within next few days or next few months. Like closing stock is also there. Closing stock is of what? Maybe of raw material, maybe of finished goods. So if it is of finished goods, you will be receiving cash after selling it within next 2, 3, 4 months. You will not keep a stock for at least 1 year. Never. Then the same thing, if you are having closing stock of raw materials, that you will be consuming within next 2-3 months maximum. So that's why either these assets will be get consumed within few months or will get converted into cash within few months. That's why it is termed as current assets. And this loose tools part is also wrong here. It will not be here. It will come here. Just a minute. It will also come in current assets. I don't know how it comes here. Control X. Loose tools will also come here because see, these will also get consumed within few months. Then next is prepaid expenses. Now, what is prepaid expenses? The expenses which you have paid in advance. Like for example, the best example of is insurance. So if you have taken insurance, it will run for 1 year. Now suppose you have taken insurance on 1st October. So from 1st October to 31st March, you will consume the benefit in the current year. But the amount which has been paid for next 6 months, means from 1st April to next 30th September, that benefit you will get in next year now. But you have paid the amount in current year. So that's why that amount will become your prepaid expense. The amount which you have paid for next financial year in indirect manner, that's why that amount will become your prepaid expense. Or sometimes what happen, suppose you have paid rent in advance for next session, for next year, 2-3 months you have paid, suppose. So that will also become prepaid rent. Then next is accrued income. And because you will be consuming that benefit within 1 year, that's why it is also a current asset. Accrued income means the income which you have earned but not received. And please now be clear about these terms: outstanding expenses, unearned income, accrued income, prepaid expenses, because these points will be coming now in a complex manner. After a few days, maybe the next week, we will be starting the adjustments. So you be clear about the meanings of each and every term. That will help you in doing this chapter in a better way. So accrued income is income earned but not received. Like suppose you have invested amount in an FD, and whenever you will receive the amount, when the FD mature, you will also receive the interest. So maybe you are closing your accounts on 31st March, but that FD will mature in June. So you have earned some interest on that FD, obviously till March 31st, but you will not be able to receive that interest right now. Whenever that FD will mature in the next financial year, then you will be able to receive that amount. That is termed as income earned but not received. Sometimes suppose you have to receive some commission. You have given some services, you are about to receive some commission. But in between, your closing date comes, 31st March. Till now you have not received that commission. So maybe within a few days, next few days, you will be receiving that commission. So that's why it is sometimes accrued commission. That is income earned but not received. Yes, please. Now I have explained each and every term on the asset side and liability side. If you are not clear about any term, you can ask. At least respond something. So if you are clear about these terms category wise, you will get little confused. In balance sheet, one query is there. Assets and liabilities balance should match. Yes, this point is there. What is the final thing? That here you will total all the liabilities. Let me show you. And suppose the total, okay, I should take the some numerical here. Suppose the total is coming 1 lakh of all the liabilities. So this total should also be 1 lakh. Means your assets and liabilities should always be equal. Your assets and liabilities should always be equal. If these are equal, means you have prepared correct financial statements. Almost, not 100%, but almost you have prepared correct financial statements. You have treated each and every account correctly. So these total of assets and liabilities should always be equal. And sequence is not compulsory. Like sequence is this way compulsory that you will write here capital, you will do these adjustments. But such sequence is not compulsory that you will be writing bank overdraft first or bills payable. Then this you can interchange their sequence. You can interchange their sequence. But try to manage at least that whatever fixed assets are there, first you write them, then afterwards you write current assets. Same way, first you write all the things related to capital, and then you write all the things for non-current liabilities, then current liabilities. So try to maintain at least that as much as you can. Right now, I will advise that you don't bother for such things. Just focus on that whether I am able to prepare the balance sheet or not. In later part, when you become some expert, you don't have any more doubts and your speed is increasing, then you can think about doing this improvisation in your presentation. But we are not supposed to write the headings that you don't need to write, but you should be knowing which one is current asset and which one is non-current asset, which is non-current liability and which is current liability. That knowledge is must for you. So that we will be, this is difference between tangible assets and intangible assets. So that we have discussed earlier also. So tangible are physically visible and we can touch them, but intangible are not physically visible. We cannot touch them, we cannot feel them. We cannot touch them. We can feel them, but we cannot touch them and see them. Because tangible assets can be non-current and current, but intangible are always non-current. On tangible assets, whatever we charge, it is depreciation, and whatever we depreciate intangible assets, that is technically called amortization, but both are same. Acceptance as security, you can keep tangible assets as the security if you want to take some loan, but lenders will not accept your intangible assets for giving you loans. So you can get loans only on the security of tangible assets. Then next is risk of loss due to fire. So obviously your tangible assets are physically existing assets. That's why they have a risk of loss due to fire or flood or whatever theft, you can say. Any loss can be there for the tangible assets. But intangible assets, because they are not physically existing, so that such losses like fire, flood, these are not there in the case of intangible assets. So this is the difference between tangible and intangible assets.